Hey everybody, this is George, and I just wanted to go ahead and start a quick video. And it was based on my conversation with Christy and with John, and we were going over a lot of different things is regarding to, hey, where's the market going next year? What are we doing as far as trying to help out first-time home buyers? And we were going through some of the metrics and like, oh my gosh, you have got to tell people what's going on so they have a better idea to make a better business plan. So today, the video today, which you should share. If you are a tenant, you need to be watching this. If you have friends that are tenants, share this. Look, there's no selling in this. We're going to just kind of walk through really why they should be looking more proactively, especially right now in today's market, why they should be looking more proactively at becoming a homeowner. So today, renters, basically, they are paying more than homeowners. And some people are saying, George, how is that even possible, right? And so at the end of the day, when we take a look at cost versus fixed cost, right, or cost that is has the ability of going up every single year or every 6 months versus a fixed cost like a mortgage, when we take a look at that and then we compound everything as far as other costs and whatnot that of our daily living, well, it adds up higher for a tenant. And that's what we're going to go over. In fact, as we go through things, so rents, basically, they were going really at a rapid pace in 2021 because they had been held back in 2020. And then, of course, we also saw a massive amount of movement with tenants and whatnot. And so as they were looking at doing new leases, we also saw a lot of folks that were starting to basically double up. A lot of multifamily generational living started to become even more prevalent than what it was before. And that is super important because the labor and statistics data found that the adjusted CPI for renters was 7.8%. And the difference is that for a homeowner with a 30-year fix, or at least a fixed mortgage, well, it was only 5.6%. Now you might say, well, George, that's like 2.2%. Why is that a big deal? Because that can add up. And especially when you're taking a look at, medium rents, in medium rent, right, at I think it's like $2,068. That's a median. That means you got a lot more higher and a few lower. And that's a big number. When you start translating that over months and a year, that adds up to be a big deal. In fact, if we actually go back and we take a look at this right here, we can actually see right here where they say that between 2014 and 2020, the personal inflation rate for renters averaged 1.1% points higher than a fixed rate homeowner. Moreover, this differential remained consistent, never dropping below 0.9%. Rising, let's see here, 0.9%, I need to finish the statement there. 0.9% or 0.9, percentage points or rising above 1.2 percentage points. As of October 2022, they found out that this spread actually went to 2.2%. Now, that's actually a big deal. And that actually came off of part of the Zillow study that they did. And, they've got some really great people, running all kinds of metrics. And we take a look at, different statistical platforms, whether it's Redfin, Realtor.com, National Association of Realtors, based on what's going on in our specific MLS, where things are going in our area. And as we take a look at that, we noticed that, and even on a national level, right, we've noticed that, the rental market has cooled just a little bit this year, okay, but not as much as one would think because the rents are still creeping up. They're just not taking that big, massive jump. And that's, again, a big deal. Now, you might say, okay, George, how do I fix this? What is the resolution? You've already told me, and I already know I'm paying too much money for rent. I get that. And I know what's going up, and I get that. And even though there are, I get now a 6-month heads up that, my rent is going to go up a significant amount, that doesn't do anything different other than giving me more time to go look for something else. How do I fix that? Okay, again, because there's no selling, I'm going to walk you through really 6 really good programs for you to consider today. And they're designed for first-time home buyers or folks that have not owned a home in over 3 years. So maybe back in 2008, you lost your home through foreclosure, or you did a bankruptcy, or something happened. But during that time, since that time, you were able to get things kind of back on track again. You would then qualify for many of these programs. So let's take a look at our next program here. Before I do that, I need to show you this. All right. Just to kind of hammer this home before we get into this, it takes 63 hours of work to pay your rent. Oh, it was $2,040. There we go. Nationally, an American average wage needs to work about 63 hours before earning enough to pay the typical monthly rent of $2,040. Now understand, that's an average. All right. It takes 3 hours more than they would have needed to work a year ago, and 6 hours more on the pre-pandemic levels, according to Zillow, right? Okay, so again, just hammering home that when we take a look at the cost of renting versus the cost of ownership, it is just truly it's just a slippery slope, because you cannot control next 6 months or the next year's rent. Whereas today, you can start to control that. And home ownership allows you to enter into that market. Now, yes, I know. There are some people who are saying, George, the interest rates are too high. Okay. Interest rates have come down over a full point, 1 percentage point. Okay. They actually had dipped down 1.25 percentage points. And next year, we're predicting that they're going to come back down again. So I'm not saying you have to run out and buy a house today, but you need to get in that mindset to look at, what can I do? If I have 6 months of a lease remaining, take that 6 months, dive in and really find out, what does it take for me to become a homeowner? Now, that could be a condo, that could be a townhome, right? That could be a single family home. Okay, and there are folks that say, George, I don't want homeowners dues. If I live in a condo or a townhome, I have homeowners dues. Okay, well, understand, that's not a profit point for the homeowners association. You understand that, right? You can either, as a homeowner, replace your roof at $12,500, $20,000 for a roof at a one-time expense over a period of time, or you can pay it monthly. And that's what homeowners dues do. Okay? They handle your maintenance that most people pay in one lump sum, but you get to pay it over time. It's a little more palatable. I guarantee you there are some folks that are getting their roofs replaced at $20,000, $25,000 that are saying, I wish I'd have paid that over a period of time. I already had that nest egg build up that I can go ahead and it's already been paid, right? So don't think that homeowners dues are the evil that they are, because they're not. It just allows you to budget more effectively. That's just a different mindset. That's a paradigm shift for a lot of folks. All right, so let's go into a little bit more of the why, right? So we already know it costs more. So let's talk about the 6 first-time homebuyer loan programs that are here to help you. So program number 1, the standard conventional FHA loan. 3% down. You'll need MI for anything less than 20% down. They allow you higher debt-to-income ratios. Sometimes a little bit lower credit scores, things like that. Because remember, interest rate is based on credit scores, okay, because risk, all right? And so by looking at that program, probably one of the most common programs that are out there. But let's talk about a couple of others. Hang on a second. So when we take a look at the same thing with VA, VA is another amazing program. Those of you who qualify for a VA loan, thank you for your service. It is truly appreciated. We do not dismiss the freedoms that have been bestowed upon us and the sacrifices and hundreds of thousands of lives to make that happen. So thank you for that. But here's the thing. VA for either active duty or if you are out of the military and you qualify for a DD 214, that allows you a zero down. Interest rates, are comparable, sometimes a tad bit higher, just because, again, it's all zero down. You're able to get certain things financed into a loan, like your loan fees and some of those benefits and whatnot. But the key is that it allows you to be able to get into a home with no money down. And it's a really great program. VA loans got kind of a bad rap years ago, many times because of some of the appraisers and some of the appraisal conditions. And, some, folks say, hey, this person, they don't have, the skin in the game. They're not putting 20% down, 10% down. They're doing zero. That's got to be super risky. When in actuality, because they have so much more flexibility on a VA loan, they're actually a stronger type of loan. So keep that in mind if you are a vet. And if you're a seller watching this or a homeowner, hey, make sure that others understand that, right? Okay. Let's move on to our next one here. So we go to the USDA loan. USDA loan is super cool because it is designed for rural areas, meaning out in the sticks. And if you're somebody that says, hey, I like a little more space around me, a USDA loan, which can also be zero down, is absolutely awesome. Okay. And there are some fees that they embed into your payment, even though there is no mortgage insurance. Technically, there's a 0.35% fee that they charge on those. So you may not have it known, but it's embedded in there. And so it's there. So just keep that in mind. Can be a little bit more expensive. Super cool loan, right? And that's really part of the great benefit of a USDA loan. But also understand, you have to make sure that the property that you're looking at is in that rural designation. You're not going to find that in downtown Kirkland, downtown Redmond, but you will find that out by like Ames Lake or way down south, maybe Spanaway, Bonnie Lake, things like that. Parts of Kent, Covington, you'll see it in there. Snohomish County, you'll see it out there, especially in Kitsap, that's considered rural. So there's a lot of different areas that you need to be more sensitive about and make sure that the home fits within that boundary. All right. Okay. Let's move on and let's see here. What do we got? We have the Fannie Mae conventional loan. Fannie Mae conventional loan is a 3% down. Fannie Mae has there, Freddie Mac has there. There are other lenders that have their own different programs, but they all pretty much write to either FHA, Fannie, or Freddie. Those are the guidelines so that they can resell the mortgages. That's why we're sticking to these top 6, because then it gives you a very clear, more common type of loan. Freddie Mac has theirs, Fannie Mae has theirs. If I pop back here, here's the Freddie Mac. Again, 3% down. Income on this one is super important. Cannot be more than 80% of the median income for the area, right? This is one, it's not like a USDA. This is more for what they politically call underprivileged, right? And so underprivileged is, areas that maybe haven't excelled as far, lower income. That's probably an easier term to understand. People don't like to hear it that way, but that's what it is. And there's a lot of communities that are like that. Not only do those exist in Seattle, and Tacoma, and Everett, there are areas that exist, like that in the east side areas, and then of course north and south, and then of course Thurston and Kitsap and whatnot. So there's a lot of areas that meet that requirement, and they have some really great programs. Now, granted, you do have mortgage insurance, and some people are like, "Oh my gosh, that's horrible." No, it's not, because of the flexibility it allows you. And on some of these programs, okay, more than half, once you get to greater than 80% loan to value, you can drop your mortgage insurance payment. Okay, now there's some that don't, so make sure you do your homework and ask, hey, is this a loan I can drop my mortgage insurance? And if it is, great. And if it's not, well, look at an alternative, because, hey, look, there's 6 of them here. You have all kinds of choices. All right, moving on. Let's take a look at the next one. So when we take a look at the Fannie Mae Home Ready Loan, that is a super cool program. What's really neat about this program, even with the, credit scores are a little more limiting, a 3% down. it allows you to actually take gift funds, and the interest rates tend to be a little bit higher because they do allow you gift funds on this, and some of the other programs do not. And again, it is case by case. So keep that in mind as you are considering this. So there are programs out there that allow you, well, greater flexibility, whether it's zero down or maybe it's getting gift funds, that are forgivable or that sit on the backside, accruing no interest, and there's no payment required until you either refinance or you pay you pay off the note. Again, it's like free money. So if you're a tenant and you're saying, oh my gosh, or if you know somebody who is a tenant and you're going, oh, hey, listen, there are options to have the ability to get into a home, even if you do not have all of the assets for a down payment. There are other ways of getting it. Just saying, make sure that you are open and understand your options that are available, right? Which, when we look at that, hey, make sure you are subscribing. Make sure that you're getting these updates because, again, there's no selling. The whole point is to help you make the best business decision when the time is right, which is awesome, right? Okay, moving on. All right, let's get back to to our next option here, which is going to be home renovation type of programs. Now, understand that there are a number of different options, and probably the two most known would be the FHA 203K or the Freddie Mac conventional rehab loan. Hang on a second. All right, the benefit of those two programs. You can take a clunker, you can take a fixer, and you can actually then finance in repairs, paint, carpet, vinyl, updated kitchen, updated bathroom. Key thing is that when we take the amount of the cost of the home plus the amount of the repairs, when we combine those two, it needs to match what the finished value. The finished value needs to meet or exceed that amount. So keep that in mind. Super cool program. We've done, oh my gosh, gobs of them. And the benefit is that it allows homeowners to take a house that is super hard to sell. So it's a super benefit to a seller. They can then go in, do all these repairs so that when they move into that home, look at this. I have a fully rehabbed house at a price and terms that are great for me. And now you go from tenancy to home ownership, and you're now entering into that equity building element of your life, which is awesome. All right. Now, you might be saying, okay, George, this is all great. You've shown me that it costs me way too much to be a tenant. Perfect. You've shown me that I have at least 6, 7, 8 different options when we consider some of the rehab type options that are out there. How do I get there? Okay. We have 3 vetted lenders that we use that share the same professional and ethical standards that we do. We will post these down below so that you have access to these. But look, at the end of the day, it doesn't cost you anything to do your homework. It doesn't cost you anything. It allows you the ability to get in there. Again, if you are, anywhere from 1 to 6 months, even 12 months out of, a lease term, find out what it takes for you to get into a loan. One, you can start preparing for the payment shock, okay, by putting that aside. And if you have questions about that, just post them and we'll answer that question. With that, if you can do any one thing to improve your credit score up to a next level, remember, rate is based on risk. If you can get up to that next level, which then drops your rate, why wouldn't you do that? If you're interested in saving money, why wouldn't you take that one tiny extra step to do what you need to do to get a better rate? Of course you would. You're super smart. That's why you're watching this video. All right. So if you have any questions, absolutely make sure you post it. And listen, subscribe, like, share this video. This is super important for you guys because it allows you the ability to really make, again, that best business decision when the time is right. If you have any questions, post them. We get back to you within about 30 minutes. Down below, we will have the links and everything that you want for this. So in the meantime, you guys have an absolutely beautiful day, and I will see you on the next video. Take care.